The U.S. and the European Union have found an agreement on trade, but how should investors be thinking about Washington's policies with these markets at all-time highs? Joining us now to discuss is Jeff Evans, VP, Director and Lead of Empirical and PM Support with TD Asset Management. Great to have you back on the program, Jeff.
Great to be here. Thanks for having me on again.
So we're getting these announcements, Japan, now it's the European Union, these trade deals as we got close to that headline. But of course, there's a lot of U.S. policy out there that starts to run through the markets. Let's put that in focus. I don't know where we're going to start. The big, beautiful bill.
Sure, might as well start there. And I think the interesting thing about all of this, if you go back to the start of the year in January, I think people were, when we talked to economists and strategists and trying to get a view of what they thought was going to unfold over the year, I think most people expected something on tariffs, maybe not the same magnitude that we've seen. But what the main expectation was that we would actually see this big, beautiful bill first. And so it's the sequencing of these two events that I think turned out to be the big surprise, that we had tariffs first, so all the downside bad news, and then ultimately the bill and the tax incentives later. That was a bit of a surprise because what a lot of people expected was that you would get this tax bill. You take the downside risk out on personal and corporate income tax. We wanted to make sure that those were extended. You have other deregulatory efforts and stimulation efforts for the U.S. economy. So I think most people thought that would happen first. Then you get the tariffs, and maybe the tariffs are a little less scary in the context of that bill. Of course, they flipped that upside down. That's why you had a lot of the volatility earlier this year, was tariffs were fairly negative, big shock to the economy, lots of downside risk potentially, and it really made it important for this bill to be passed and fairly quickly to then try to create some calm before the tariffs really started to bite. And even that, as early as the end of June, there was a lot of uncertainty as to whether the bill would go through. Early July, we were actually hearing, even end of August into September was a very likely possibility. So I think very much a net positive that this came through in July. And when you start putting some broad numbers on things, if you look at the tariff revenue that the U.S. economy is bringing in today, it's running around $30 billion a month, so $300 to $400 billion a year of effectively cost on the U.S. economy from tariffs. What the OBBA brings in fiscal benefits is roughly $300 to $400 billion in 2025. So from that perspective, this year it's effectively a wash, maybe even a slight net stimulative effect on the U.S. economy this year. And then as you get into 2026 and you get the full ramp up of these, a full tax year of the benefits, and companies have the ability to really start digging in and taking advantage of them, that fiscal probably steps up to around $600 billion. And then as companies and consumers adapt to tariffs, you'll see a lot of potentially onshoring or people just changing their consumption patterns. That tariff revenue probably, or the drag probably drops down to more like $200 to $300 billion. And so those two things together make 2026 a much bigger year for net fiscal stimulus. Really the key though is what this bill has done effectively is taken out the downside risk from tariffs. Other things can still go wrong, but at least the tariffs now are kind of risk managed in a way through the bill.
Oh, interesting. Okay, so when it comes to those tariffs, you say there's still a few wrinkles out there that perhaps we need to be aware of.
For sure. First one is there are still a lot of agreements that are in motion and need to be sorted out. Japan and the EU are very big trading partners, so it's nice to see that those are hopefully settled. Whether they stay that way or not, well, I guess we'll remain to see. But it's helpful to de-risk some of the larger trading partners. Where you still have a lot of open question, of course, is Canada and Mexico. Trump has been chatting more recently. It might be difficult to come to a trade agreement. There's still a lot of uncertainty if there is an agreement whether the CUSMA compliant goods would be included or excluded. So for the time being, unfortunately, we still have some uncertainty on that side, and that's really the biggest trading partner with America. We need to ultimately get to a point where those deals are sorted out. And then the bigger issue is what's going through the courts right now. There is a court decision, or I guess a court date this week, where everybody's going to be arguing over whether or not the IEEPA tariffs and the mechanism that they've used to put tariffs in place, whether the administration has the authority to actually use that to impose tariffs. The original wording of that, when Congress created it back in, I think it was the 1970s, there was no explicit mention of the ability for a president to enact tariffs. Under the U.S. Constitution, that's typically viewed as something that Congress would have to do, and it's notable that they didn't include that in this bill. So what you're going to see is, at least the first iteration of that through the courts this week. It's expected to potentially end up with the Supreme Court by the end of the year. And the very interesting result could be if the court finds that these tariffs are illegal, the U.S. could actually be required to refund fund all of the tariffs that they've collected so far. What they'll ultimately have to do is then find other mechanisms through things like Section 232 or other tariff mechanisms to put them back in place. But the point is there's going to be still continued volatility and headline risk over exactly whether these tariffs are legal under certain mechanisms that they've used. So you're just going to continue to see a little bit of uncertainty over the balance of the year until all those legal issues are sorted out.
Yeah, their concern about tariffs, of course, was that they would be inflationary and that would be a problem for the U.S. economy and for the U.S. consumer. Are we actually seeing that play out at the moment?
We're starting to see little bits and pieces of it. And of course, the thing is, when it became apparent that tariffs were coming and they were going to be bigger than expected, a lot of companies started to front-end load their inventories, bringing in and importing a lot of goods ahead of that. We saw that in the trade numbers from Canada. We started to see a lot of shipments trying to come in from China to get ahead of this. And so that gave companies a couple of months of buffer where they could sell down older inventory without tariffs. We're likely getting close to the end of that, if not already at the end of that process. And that would be roughly about the end of June is where you'd expect most of those inventories to have been depleted. So you're starting to see that starting to come in now that it's now tariffed goods that are coming in. There was also a survey that the New York Fed did maybe about a month or two ago where they asked companies how quickly would you pass on price increases and how much would you pass on. And the view was most companies would pass on price increases within 1 to 3 months. And generally about 25 to 50% of the cost would be passed on right away. The rest would kind of dribble out over a year or two as customers adjusted to it. And so what that ultimately means is we would expect that June, July, August is kind of the time frame where you start to see this in the numbers. What we saw in the June inflation report was all of the tariffed goods, things like toys, sporting goods, apparel, any household discretionary item. If you're doing a renovation on your home, for example, you'd expect to see some of that, starting to see price increases. What's interesting, though, are the offsets. You're also seeing consumers, if they know that inflation is going to tick up on durable goods, pulling back on things like discretionary travel, airline fares, hotels, dining out. All of those things have seen a little bit weaker inflation. And so that's, there's always going to be a bit of a give and take on which one wins. We are seeing a little bit more inflation on goods. There's a little bit of substitution coming in, but it broadly seems to be playing out the way people expected, and at least the way the market reacted to the June report, things are looking okay. Where we're really going to start seeing this is July and August. I think those are the key months to focus on. That's where you really start to see these price increases. If they're going to be passed through, it'll be more in those months. So we'll have to see how this plays out. But the good news is, hopefully by September or October, the big increases have worked their way through the system, and we'll have a better sense of what the inflation level would look like at that point.
So we put that all together, and as investors, we are dealing with a lot. And you take a look at markets at record highs. What happens from here? What's the path forward?
Exactly. It's always a concern when markets hit a new high. What should I do? Do you take profits? Do you stay in? We did a little study on my team last week of this. It's very simple. We went back to 1929 and all of the S&P 500 data from that onwards. We looked at any week where the S&P 500 hit a new all-time record high, and we said, what's the probability 6 and 12 months later that the market's even higher still? And it works out to about 70% of the time. And so if the only thing that you knew was the market's at a new high, what should I do? Probably the statistically right thing to do is to stay invested. Now, that's over the very long term. There are a couple of wrinkles right now. The biggest one would be the S&P 500 is trading close to 24 times earnings today. You'd have to go back to the dot-com bubble to see similar valuations. Now, the offset to that is there's also some very high growth expectations behind that. And so it's not just a bubble in valuations. There is some very strong growth. But if that growth doesn't materialize, if we see any sort of bumps along the way, that combination of high but declining earnings growth and multiple compression, maybe that shifts the odds to more like a 50 to 60% probability of the market being up over time. So what we've really been focused on is market internals. What types of stocks are investors buying? Are they focused on defensive equities? Are they worried about a downturn? Or are people just focused on risk on more cyclical type companies? And what we've seen in our empirical models is very, very clearly everybody's risk on. Nobody's focused on defensive sectors at the moment. There was that little blip in April with the uncertainty. Of course, everybody rushed into defense, came right back out. And we've been seeing this pretty much since the bottom of the market in November 2020 is a very strong cyclical risk on, higher beta tilt in the markets. Usually that's consistent with the rising equity market. We're not seeing any shifts in that right now. But at some point in time, you'd expect that. This is actually very unusual to have 5+ years of defensive underperformance. And what we think would probably drive that is any uncertainty in the earnings growth profile, you could have a rotation back into defensive sectors pretty quickly. Ultimately, what we think investors should do is start to diversify the portfolio a little bit in advance of that. The worst time to diversify is at the bottom of the market when people are panicking. It's a great time to start adding a little bit of defense proactively, stepping in and just gradually increasing the allocation. Particularly things like real estate and infrastructure tend to have very low correlations, low volatility. This is the time we want to start thinking about it and making sure your allocation is appropriate.